It gives me great pleasure to present our budget's interpretation after yesterday's budget, and it gives me great pleasure to welcome you for the next hour or 90 minutes after last night's budget by Tito Mboweni, our Finance Minister. And before I go through a couple of points about the budget and introduce you to our very special guest speakers, when one looks at the budget, and people always ask you 3 minutes after the presentation, what did you think of the budget? Was it good or bad for South Africa, for taxpayers, etc.? I'm always reminded by the joke that someone asked the Chinese leader Mao Zedong many years ago what his views were on the French Revolution of 1795. And he thought for a while and he said, it's too soon to tell. And against that background, one needs to consider annual budgets. Every year we have this massive build-up to a budget, and there's always scary stories about massive taxes or tax increases or tax decreases. And especially in the context of a country suffering from many economic ailments, and in the context of the COVID-19 pandemic of last year, it was said that this budget will be a seminal budget, one of the most important since 1994. Well, we've had the budget, it's come and gone, and analysts have been analyzing the budget ever since yesterday afternoon, just after 3, and will continue to do so for the next couple of days, weeks, even months, as the long-term effects of the budget become clear. But with that in mind, let's move on to just a very quick briefing of where we find ourselves. If I can get my pages to move, let's see what happens. In essence, as I said, we have Mark Schüssler, our award-winning economist, who's just been appointed as the consulting economist to the Brenthurst Wealth Group, and he's going to be talking first for about 20 to 25 minutes. And if you haven't heard Mike or read or seen some of his analysis, have a look on the front page of Business Day / Business Live website today for a very good analytical piece about the budget that was delivered yesterday. And followed by that, we have one of our upcoming and independent thinking analysts, Phumlani Majozi, who's a business and macroeconomic analyst from Africa Liberty, and he is also non-executive director of a range of companies. So I look forward to hearing what Phumlani has to say about his interpretation of the budget. Very quickly, and some of you might have heard or seen this, but in essence, the budget is about how much can we spend and how much are we going to collect. And for the first time ever, our expenditure will breach the 2 billion rand in the next year. In fact, the budget total is 2,052 billion rand. And the government expects to collect tax of 1,365 rand. And so there is a very big gap between those two, and that is called the budget deficit. And where is that going to come from? Well, as Tito Mboweni said yesterday, we owe a lot of people a lot of money. Well, after this budget, we're going to owe a lot of people more money because the gross debt has increased from 65.6% to 80.3% of GDP for the year 2021. Now that is a massive jump, and that is a number that the ratings agencies look at when they assess South Africa's creditworthiness. How big is it? What is the trajectory? And when can we hope to bring it down and under control? Some other points about the budget. The corporate tax rate is set to go down, but only from April the 1st next year, not in this tax year. So he signaled something which is quite positive, that he'd like to see income tax or personal company income tax come down. But the big item, I think, and I think our two guest speakers will support me in that, is that 47% of our annual revenue is spent on paying government employees, and that should be a matter of concern. And then, of course, he mentioned the wealthy individuals who have, as he says, complex tax arrangements, who have been identified and maybe investigated by SARS as from April 2021. This is, of course, a consequence of the common reporting standards where various tax jurisdictions all around the world now exchange information on the assets held by investors and taxpayers in other countries on a voluntary basis. And then lastly, a smaller item is that there was a slight adjustment of the so-called bracket creep, which effectively is a slight reduction in personal income tax, but not enough to affect the overall tax base or the tax take from the economy, as Mike so very elegantly wrote about in Business Day today, saying our tax take is the highest ever in the history of South Africa. So with that as a background, and of course I need to mention the exemption of foreign remuneration earned by South African residents abroad remains unchanged. With that as a background, I'll hand you over to Mike Schüssler, who, as I said, is a very well-known economist and also the consulting economist to the Brenthurst Group going forward. Mike, welcome, and thank you very much for your time today.
Thank you, Magnus. I'm just quickly going to share my screen, and I hope you can all see the presentation.
We can indeed, thank you.
Okay. Well, the first thing I'm going to do is, thank you, Magnus, is just to look at our growth and a forecast of that growth compared to other emerging markets. I'm going to look at revenue. I'm not redoing the government slides. I have a thing about it at the moment, and it sort of frees my mind to look at the budget differently. And that's why I'm going to look at revenue compared, expenditure compared, deficits compared, and the servicing and what it all means and how we should look at it as both South Africans who wish to help the country as much as possible, and as well as to, you know, from a purely investment point of view. The first thing is, you can maybe see here, but the forecasts for South Africa are not that bright when compared to other emerging markets. Emerging markets have been growing at 4.7% over the last decade, and it's 1.2% for South Africa over the last decade. It's a simple average. It means we've been growing at a quarter of the speed of the actual emerging markets. Into the future, we grow at about a third of the speed, according to the IMF. But even whatever way we look at it, even if we take out China, because they're a big chunk of that growth, we're going to be growing at roughly half the rate of the typical emerging market out there. And that's not good enough. That's not good enough for a population that's growing. We are falling behind in every way. Yes, South Africans are getting poorer, and this year particularly. The last time South Africans got richer per capita basis was in 2014. So we have to take that into account, that we've been slowly getting poorer. And if we go back to the mid-90s, when South African citizens on average were 62nd richest in the world, we have now fallen back to 107th. So we really need this growth, and this growth will help things like budget revenue and therefore expenditure and the likes. Now, if we look at revenue, it is a huge burden on South Africa. It is a huge burden on all of us, and it is under pressure. And that is the thing that the government is trying to do, or Mr. Mboweni. I think he really tried to help us a bit here. But if we look at the emerging market tax burden overall, just the taxes, then you'll notice that our neighbors and us have some of the highest tax burdens in the emerging markets. And those neighbors like Lesotho and Namibia and Eswatini and Botswana receive between 20 and 60% of their income from South Africa, from the customs pool. So all the customs we collect in all 5 countries, 85% goes back to the smaller countries and only 15% comes back to us. So the real picture is actually that we, South Africa, are by far the highest tax revenue collecting part of the emerging markets. The other thing I'd like to just point out is if I look at this picture and I say it's without social security payments, the reason I'm doing it without social security payments is that ours are private. You pay your pension privately. Your insurance on your disability side is private, whereas in other countries, it is part of government social security that they provide you. And that's why the UN makes a distinction between inclusive of social security and inclusive of social security. So if we look at total revenue, and now I'm saying this is everything, except social security and grants from other countries, because you could go to East Timor and you'll find that their revenue is over 100% of GDP at stages, because a lot of countries were giving them money. It's a small country, and to rebuild their economy. That's not going to affect much of South Africa or much of the comparison here. And again, social security contributions also generally go back to the same people that pay it in. So Denmark is way ahead, and followed by Sweden and Finland. But South Africa is really number 7 in the world of countries that have this data. There are 151 countries that have data for their total revenue. South Africa has the 7th highest total collection. Yes, it includes water and lights, but in other countries too. It includes things like PRASA and ICASA and SANRAL and all those. It excludes state-owned enterprises. But if you look at this, this is huge. We're out of sync. No emerging market other than our neighbors are here, like Lesotho is here, but they get their money from us, as I said. But look there, Cuba, a communist country, is at 33%. We are at 37%. It is incredible that we're at these sort of levels as a relatively poorish emerging market these days. That's just not done. If I look at the total South African tax take and I look at every aspect of it, our company taxes are the 7th highest in the world. The burden, not the tax rate, the actual taxes paid. And it's been for years now. Sometimes it's even been in second place when we still had the secondary tax on companies. The personal income tax rate that me and you pay, the highest burden or 10th highest burden in the world. So the take that we take is over 10% of GDP. That puts us just at number 10 in the world today. And these are numbers for 2018, 2019, before the crisis. VAT and sales tax, only 103 countries have those numbers. Quite a few countries, especially oil countries and so on, do not have that. So out of that, we're 53rd. So a little bit in the middle, but that was in 2018, and that was before the VAT increase. The excise burden for South Africa is 39 highest. Only 101 countries have an excise duty of some sort or another. For total non-tax revenue, just the non-tax revenue, we are 14th, sorry, that should read 14th highest and 23rd highest with oil exporters. So we are high. We've got a lot of other things, and that's your water and your lights, your bins, all that type of stuff. The UIF is a non-tax revenue, but it obviously is a social security. That's the only one that we have. Our trade taxes are 50th. We rank 50th in the world. And, here again, you've got a lot of countries that don't charge, but approximately 125 do. So we're definitely in the top half. But if you leave out our 4 neighbors who end up having being 4 of the 5 highest ones, because they take our money from it, we take that money back, the fair share of that, we would rank inside the top 30. So again, we're in the top quarter vis-a-vis trade taxes, that's import duties and the like. So if I just take a look at the history of individual income tax, you can see under Trevor Manuel, it was brought down. It was already very high there. But generally speaking, it is really a high rate. It's been going up for quite a while. And every time we hear how it's going to come under control. I believe that Mr. Mboweni is going to do more than the previous finance ministers here. I don't want to dish him in any sort of thing, but this is where the relief has to come. You cannot have this sort of level of taxation of individuals as a percentage of GDP. Just to put it into context, the individuals in the South African economy earn about 55% of the GDP. They pay 10% of GDP in taxes. So that means that's very close to a 20% tax rate right through. And that would definitely be one of the higher ones in that sense as well. The reason I put this graph in is just to show what the impact of these high company taxes are. This is apart from red tape and localization policies such as BEE and the like. What we have here very simply is South Africa is the only, let me repeat, South Africa is the only emerging market of the biggest 20 that does have a negative fixed investment, foreign fixed investment. In other words, we invest more in other countries than they invest us. In fact, the JSE is virtually no longer really a South African thing. It's South African companies very often trying to invest in other territories. And therefore, it is really becoming a situation where you got to choose whether you want to buy the other companies directly or you want to go through a South African company. And people are leaving. That's the long and the short of it. And government does not understand that their taxation and their rules and their fight with what they call monopoly capital, when you're talking to the radical transformation, not when you talk about rich business people, when you talk to the more moderate people, are chasing this away. And this chases jobs away as well. Our 6 biggest taxes, well, they are not quite as bad as they could have been. But I want you to look at the second dip, or the second last dip. That dip didn't happen because of fewer taxes. That dip happened when we had more taxes. We increased VAT there. We also increased fuel taxes. We didn't give people the bracket creep and the fully then. And what happened is that people just cannot carry on like this. And the Laffer curve is starting to have an impact. So if the minister increases taxes, the actual tax take is at risk of actually declining. And that's the madness of this whole situation. Now, the other side, as Magnus said, we're talking about revenue and expenditure and the difference between the two and how that impacts us and the economy. Now, here's something that I wrote about, that Magnus alluded to, but this is general government expenditure, excluding social benefits. So when I don't take into account social securities, I don't take social benefits into account when I compare countries. And here, my friends, South Africa beats everyone. We have the highest government expenditure in the world, excluding social benefits. Everybody says we must be like a Scandinavian country. Well, we beat all the Scandinavian countries. Everybody wants us to be like Europe. We must have 14 kids to a teacher. Well, we have 40 kids to a teacher, but we still, spend as much as more than Europe, who has 14 kids to a teacher. And this massive expenditure is absolutely eaten up, not just by salaries, but by corruption, wastage, interest rates. We'll talk about that. And it is incredible that this has been allowed to happen in an emerging market. One of the emerging markets that has been seen as very socialist in nature is Brazil. Another one is Russia. Yet both are lower than us. And I can promise you Cuba is too. So we are much closer, if you wish, to a country where the state plays a bigger role, quite frankly, on every level. If we look at a little bit of time shifting here, we look at total government expenditure, and these days they make a difference between that and the non-interest expenditure. They foresee it coming down. But even in their foreseeing it coming down, which I doubt will happen, I'll tell you why just now, 100% like this, I think they're going to try hard. And so on, but we only go back to 2018 levels, between 2018 and 2019 levels. So we don't go back to what we were before. And if you look at the other one in 2020, look at the big emerging markets and look at South Africa. It's basically the BRICS, if you wish, with Turkey added and so on. Their government spending as a percentage of GDP, and that includes China and Brazil and Russia and those that you saw, in 2020 by the IMF is going to be forecast at 35.5%. For South Africa, it's 41.1%. So it's a very different ballgame when you've got that extra 6% of GDP there. You can see here, there's been a doubling of government expenditure in 40 years. It's gone from 21.7% to 43.2%. That is huge. And you eat up a lot of the possibilities. But despite this big expenditure, we get less of a perfect justice system. We have weaker education outcomes than most countries in the world. These days we have more potholes, not just because of the rain, because the government here in the place I live, the tar and the stuff that they need has run out. And this is a big city in South Africa, or a part of a big city. They have to go and borrow from other parts of the city before they can set out our potholes or fix our potholes. So quite frankly, on top of that, I have to spend extra money on security. There was a robbery just last night on our street. So we need private security. We need healthcare that works. And we don't want to be locked in the government healthcare, because even some of the previous directors generals of health said they don't want to end up in a public hospital. So that's where we are. And if we look at what we do, well, our government employees take, if I break up that spending, they take a huge chunk. So they take 15% or 47% of all taxes, but over 33% of all income, including non-revenue income. I could add the state-owned enterprises to this, and I'll add another 2.5%. So ultimately, what we have is the whole private sector, which is 14 million odd people, and the government, which is 2 million odd people. We have the 2 million getting 15%, the 14 million getting 40% of GDP, because we only get paid 55. The rest goes to depreciation. It's the house you stay in that has a value for GDP if you don't know it. And obviously some profits. And then what we call mixed income for employers. But if we look at this situation, quite frankly, if you paid the 14 million the same as government, that would be 106% of GDP. And you still have to add the government to it. So that just shows you how out of sync it is. And also note that all the countries on top here have very high inequality. The more you pay your government civil servants, it seems you have higher rates of unemployment. In other words, the difference between the poor at the bottom and the rich on top, yes, the rich these days, half of them are in government, come there. And you can go and check it if you want. But Namibia, South Africa, Lesotho are on the top there, Eswatini, and even Botswana is not too bad, not too far from the top. And you can see countries like France, Sweden, United States, everybody pays their civil servants far less than we do as a percentage of their GDP. The social benefits, they're not as high. You can see Brazil has a lot more social benefits, so does Turkey. But we're still on the higher side of the emerging markets because we want to have everything. And this will increase if the unemployment SASSA COVID grant carries on, because there's already 6.5 million people there. Now think for yourself, we have 6.5 million and it's probably going to go to 9 million. And I feel sorry for those guys. And we have 18.5 million people on SASSA grants. This is a political thing. So yes, between those two, we end up with 28 million people if we go to the full 9 million and the people that receive UIF. And that's supported by very, very few people in the economy. And that is unsustainable too. But this is perhaps even, the other thing is, this is perhaps more sustainable than the government salaries. We could bring down government salaries below 10% instead of 15%. We have the money to do a lot more on the social grant side. But that's a moral choice and it's a political choice. And that's what's starting to happen here. And I got a sneaky suspicion that the 9 million people will continue getting their income as well. The interest payments are also interesting because here we're also in the top third. Not all the countries in the world are listed here, but you can see I could have put in Sri Lanka, which would be far above us. But the point of the matter is we're definitely on the top third here and we're going up. So yes, the United States has more debt than us, but they're a reserve currency. They manage the interest rates easier and therefore they pay less on that more debt. But if you look again at Brazil, which has a similar amount of debt to us, a little bit more now, I think, and India, they're paying a lot more. India doesn't have quite the levels that we have, I think, but ultimately we are in the top third. So interest payments, and they don't go away, they're going to get more. So this is going to squeeze the other two main categories and the goods expenditure, and that's where I'm now. If I look at the goods and services, then from this year onwards, I expect and government expects that goods and services will take less of the money than our debt service costs. And I think government is being very optimistic with its debt service costs going forward. They were at 5.9. I think they've manipulated this thing down a bit by modeling it differently. But ultimately, this is telling you that debt services take a heck of a lot more than the total health services, but they also take more than all the medicine that we buy in South Africa, all the school books we buy, all the roads we build, all the accountants government pays to check out its corruption, all the people that are busy there at the Zondo Commission, all those sort of things. If you add them all up, they do not make up what we pay in debt service costs. So you can see how that squeeze is going, and that's where the main cutting is coming in, but over the years already. But I think now they're going to try and do it on the compensation side. The result of this is that government does not invest in our country. And you can see that in the sense that government talks a good talk about investing, but government investment is less than 3% of GDP. The private sector is 15%. We should be where the world average is at near 26%. And that is as an emerging market, as a minimum. Even if we take out China, we're looking at 24%. We are way below where we should be. We should be putting in 1.3 trillion rand into fixed investments in this country. The private sector needs profits to invest. That's the reason they invest. But also, you've got to remember that the private sector wants to see that the government has got to hope for our future. I can tell you now that South African government, of all the countries that I've seen, not talking all emerging and developed countries, which are normally less, we've got those numbers. They, apart from Britain and one or two others, our government puts in less into the economy in fixed investment. And that's going to come under pressure if we've got more debt service costs. So government spends far too little here, and that is the problem. Now, on to the big issue, and I need to clear this up very quickly. Our government debt is unsustainable. It's certainly below advanced countries, but there's a difference. Advanced countries are richer, richer people can afford more debt, they can repay, they will still pay 10,000 Rand a week or a month on food, whereas poor people, they have to spend all their 1,000 Rand on food. They haven't got anything extra. So just the same thing there with debt, and I'll get to it. But here's something. I think government needs a debt counselor. If you look at South Africa, we have 17 million families. Each family on their own, on average, has 102,000 Rand in debt. Government debt per family, the debt the government has made for us is 218,000. So it's double what we've made for ourselves. Government has doubled that. If you look at the government guarantees and we look at the state-owned enterprises, we get to about 2.5 times that government and its agencies and its enterprises have made on our behalf. I haven't even added the actuarial deficits here. And all these numbers are for December 2020. The ratio will get worse. Government needs a debt counselor. They need one seriously. And they are not interested, but they want us to go and see debt counselors. Nothing against debt counselors, just saying. The emerging market debt to GDP ratio here, you can see Brazil is high. India is a little bit higher than us, about 10%, and Zambia as well. But we're getting there very quickly. And this is from the IMF. And I think if you look at the budget deficit over the last year or two, you'll see ours has increased far more than those countries above us. Argentina particularly is constrained. They really can't make more debt. They've got a very, very big problem. And around us, our neighbors are making debt left, right, and center too. So this whole environment needs to be addressed. And then you've got Zimbabwe, which, like Argentina, cannot make new debt. Nobody's going to borrow their money anyway. Here you can see our trend. The gold line here in the Brenthurst gold is going up. And it's not a gold price. It's a debt level. And the debt to GDP here, this is a bit different source. This is the Bank of International Settlements. Slight changes in definition. But you can see here, there's a 16% gap, 1,600 basis points, if you wish. Means we have 28% more debt than the average emerging market. And we used to have 20% less. So we've really ratcheted that up, and that's the problem. So what's happened is our debt and country rating to GDP, you can see the ratings, they pretty much correlated here. And I'm not going to go into too much detail, but the more debt we make, the more this rating will come down. The other thing is that, the budget deficits over 10 years. Now, unfortunately, my colors didn't play along here. But what I'm trying to say is that Argentina and Zimbabwe have 1 or 2 years estimated. I may have underestimated Zimbabwe a bit, but let's shift them to 4%. The point is, South Africa over the last 10 years has had a higher budget deficit than the emerging markets here. And if you then look at that picture, it tells you that it's a very, very difficult situation for us to get out of. Argentina here, the reason I've also got it colored in, they had a lot more higher deficits in the early part of this decade. Now they've got much smaller ones. So they're coming down very quickly because they can't afford more debt. Nobody borrows to Argentina at the moment, unless you don't want your money back. And this is the problem here. We keep on saying, we're going to stop this. We're going to stop this increase in debt to GDP levels. We drew a line at 40% to debt to GDP in 2009. We beat that. In 2011, we said, well, 43%. It came in slightly higher. 2014 came slightly higher. 2016, we went 6% higher by 2019. You can see each time. So we don't keep to these promises. So I can tell you now that the 85% that we see in the future is not going to happen. Not on this history. This history says to us, when we say we're going to have 59% debt, we're not going over 60%. I even know that's what we were saying. And when we came, choop, it went up. And you can say, yes, it was Pravin Gordhan and Malusi Kigaba and Mr. Nene, but it was also in 2019, Mr. Tito Mboweni. Our government does not keep its promises, and this time round, it's serious. Our total debt to GDP held by non-residents is quite high. It's come down in the last year or two to about 32%. And that's the part that we need to make up if it leads. And that's going to be a very big issue. The country ratings, what impact do they have on the long-term government yields? Well, when your ratings go down, your yield goes up. And you can see that here in this correlation. We need to take care of that. And that's going to be a double whammy if foreigners also leave. This is just a very simple model. Our average time period of a yield or our borrowings is 11 years now, but the weightings of the interest rates have come down. We've been lucky because the international environment has become a lot better. If that goes wrong, we're going to have a problem. I'm nearly finished. We're going to have some small relief for PIT, as Magnus said. The company tax rate declines to 27%, apparently only now, not next year, the year after. But the devil is going to be in the detail. All hinges, literally all hinges to a large extent on a wage freeze. And that's the question I have. The political suicide, because the president, Ramaphosa, is dependent on the unions. Gwede Mantashe is a union man. His education minister is a union lady. A lot of the people that support him on the NEC come from the unions. Once the unions don't get their pay increases, and they effectively had nothing last year, and they're taking this to the Constitutional Court, you give them 2 more years of wage freezes, you're going to see up in arms trade union movement that's going to make life very difficult for the president. And I don't know if that line in the sand can be drawn and held. It's drawn, but can it be held? I don't think so. And I think the other thing is the employment grant, the unemployment grant is going to become a permanent fixture. And that is going to be very interesting how that plays out, I think. But that alone adds 0.8% to our GDP if it continues. That's if 9 million people get 350 rand a month. But if we don't address this, so it's a question, do we follow the politics and allow the president to govern, or do we commit economic suicide, or do we address the economy and the president and the people around him start committing, in actual fact, political suicide? And the government knows that it has to keep the line here. So they're making promises in the budget, but can they keep them? That is the big question. And the other times we didn't keep our promises has meant that our interest rate, the premium that we pay over other emerging markets, and I'm using emerging markets, is now over 500 basis points. So it's over 5%. In the last while during President Ramaphosa's time, it's nearly 400 basis points or 4%. That's a big difference. If interest rates in the rest of the world start heading up, and we're starting to see a little bit of that sign, but I think we'll get away for another year or two, we are going to have a problem here. We're going to all of a sudden find our debt service costs are going to go through the roof, and it's going to hurt. It's really going to hurt. And people are going to take their money out. The last thing is the emerging markets. I think it's good to compare us to the dollar, but I think it's sometimes better to just compare us to emerging markets. The rand has fallen at twice the rate since 2010 than the average emerging market. Yes, we will get respites. You can see it's not always a straight line down. And I think this year, for a while, we might be stronger. I have no doubt in the next month or two still. But in the end, in 2, 3, 4 years' time, our currency has proved itself over time to be much more volatile than the rest of the emerging markets, and more generally, we tend to fall more than they do. Magnus, I think I'm finished, and that should leave some time for Phumi. Sorry about the thing.
Mark, thank you very much for that. That's excellent. It's not great news, but at least it's objective and it's independent. And we thank you for that. We're going to ask our attendees if they've got any questions. We have some questions coming through already. Like, for instance, is it safe to invest in government bonds? It's maybe a question we can answer later. And some other questions about the RAND. But Mike, it's a very sober assessment of the situation that we find ourselves in. And that's why we have approached Mike to become our consulting economist, because you get the views as they are, not as people would like them to be. And I think that's been a big issue in the investment world, where a lot of the embedded economists are hamstrung by what they can say or what they can't say. So we appreciate that, Mike. Thank you for that. We're going to hand you over to Phumlani Majozi, who's been attracting a lot of attention in the writings and stuff that in the work that he's been doing. I've just been reminded by my team to tell you that this broadcast is coming all the way from the Valdevie estate outside of Paarl, where Brenthurst has just opened its 8th office in South Africa and the 5th in the Western Cape, and that already tells you something. There's been a massive movement of people towards the Western Cape, Stellenbosch, Franschhoek, and the Paarl area. So we are happily ensconced in the winelands here, coming to you from the Valdevie estate. So I'm going to hand you over to Phumlani Majozi, and thereafter we'll take some of the very good questions coming through now that you can put through on the question and answer. Phumlani, once again, thank you very much, and we're looking forward to hearing your talk.
Thank you so much, Magnus. Thanks, Mike. Great to be here. It's an honor to sit with you, the two, one of the best South Africans. So it's exciting to be here. So I don't have fancy slides like Mike, fancy data. I don't have that, but I'm just going to basically give an overview of what I think where we are, given the budget that took place yesterday. And my view is that my view remains negative after yesterday's budget speech, because really nothing has changed, not much really, from the very negative kind of numbers that came out in the medium term budget last October. Really, there isn't really much that has changed. And for us, was I was sensing this kind of excitement. People, I was looking at the pundits, commentators kind of cheering at what Tito Mboweni said yesterday. And for me, it just showed me that, the bias becomes so low, because when you look at the numbers that Mike has just shown now, when it comes to government debt in South Africa and compared to emerging markets, when it comes to deficits, when it comes to the expenditure, by the way, that has shot up and up and up over the past decade or so, yet what we benefit as citizens out of that very sort of staggering government expenditure is very dismal, right? You could be talking about government services, you could be talking about education, you could be talking about so on and so on. And you could be talking about the state-owned enterprises where we put in the billions of rands, and what we get back is totally shocking, including basically the collapse of those businesses, the fact that they are in financial troubles. So for me, the numbers still look bad, right? And one of them, I like what Mike said, that history is very important to refer to look back. And in this instance, right now, when they say they want to reach a peak of government debt to GDP of 88.9 or something right over there in 2024, 25, if they talk about reducing government expenditure and reducing government debt, the fact that these people, they don't have credibility, right? And they don't have credibility because, as Mike showed earlier, that they promise that something will be done and then it doesn't get done, right? We'll be at X, percentage of X X debt as a percent of GDP, and then they go beyond that. We've seen them doing that again and again over the past years. And there is also refusal to, we've seen the refusal from the ANC, to be specific and to be exact, from the ANC to pursue the reforms that will get South Africa on the right footing. And the right footing means strong economic growth. It doesn't mean anything else. That's the right footing you need. Because when you look at South Africa's data since 1994, what you see is that where we had relatively lower levels of unemployment, those lower levels of unemployment were accompanied by stronger levels or relatively stronger levels of economic growth. Today, South Africa's economy is a total kind of stagnant, really kind of a dead economy, to be honest with you. And it didn't begin with COVID-19 that reached our shores in March last year. No, it didn't begin with that. Even by March last year, that quarter, by the time we reached that quarter, I think for the second quarter of last year, unemployment rate had really shot up, right? We had dismal growth. I think we had more than one recession under Cyril Ramaphosa. The debt was still going up. So the fundamentals even then were bad, right? It's just that now, because of what happened, the lockdowns and so on, and a great deal of also mishandling from government as a policy response to the pandemic, we've seen things getting even much worse, with millions of people, losing their jobs, unemployment skyrocketing, as we heard this week of how the numbers have moved up when it comes to joblessness. So the ANC has been, if the ANC says that, Tito Mboweni is one of the top ANC people. So, he gets his thinking around in the ANC. So if they say we are setting these goals to reduce government deficit by X, to reduce government debt by Y, to reduce expenditure by D or Z. It's hard unless they have the fundamental sort of reforms that they pursue in order to get there. Then that's not going to happen, right? Because to reduce government debt, to fix the fiscal situation, you need a stronger economic growth, and for that to happen, you need to pursue or touch on the reforms that the ANC has for many, many years, over the past decade, basically, refusing to touch on, right? And those are structural reforms, basically. We could be talking about the labor market, where basically, apparently even the labor cost in South Africa, when you compare it, the World Bank did another study a few years back, but when you look at the labor costs in South Africa, they are very much higher compared to many other emerging markets, right? So what you have is that you have a labor market that is very much regulated. We are seeing even there's been also an implementation of the minimum wage. We are seeing regulations being put up more and more in the labor market. We are seeing unions as well dominating their space, right? So as a result, the ANC, I guess it's one of the reasons why they don't really reform that, that aspect of the economy. You also need to deal with taxes as well. You need to fix things like education. If you really want to have long-term prosperity in South Africa, you need to address all those issues. So we don't see sort of strong or a push really to kind of bring in the private sector in what is currently called SOEs, right? As the first step, perhaps partially, but I'm one of those people when it comes to business operations, where I always say that it has to be driven by, private citizens. I'm talking about businesses. Government doesn't have to own businesses. So there is no push in structural reforms. And as a result, if they say we are going to do this by 2024 when it comes to our fiscal situation, they don't have credibility because we don't see the work that would lead to that being done, right? So as a result, the numbers they are telling us right now, they are just really based on projections that are really empty. And given the fact, even the minister said that they are still having these negotiations with the labor unions, and we know how you know, the relationship between the ANC and these labor unions, it dates back to many years. And Mike mentioned that if unions don't get their way, we may see things, you know, getting out of hand. And I think that's a good point, because what I've heard is that what could happen is that if the unions don't get what they want, then the next step for them is to do what? Is to stall the operations of the public sector, right? They will stall it by protest, by, you know, and so on and so on. That will basically make sure that government responds in their way if they don't get what, you know, what they want. So I'm quite negative in where we are right now, and you know, I just think that we are led by people who, for many reasons, aren't really doing what needs to be done in order to jumpstart, you know, South Africa's economy, to push it forward, to reduce the shocking, very shocking, even by global standards, levels of unemployment, shocking levels of, you know, economic growth. We are not seeing that. And what we're being told yesterday is nothing just other than things that are not really based on anything. And you know, one thing that they said was that, okay, I mean, fine that we saw personal income taxes not being increased, of which I saw it as that even before the budget. That was how I saw it. But, you know, you still have things like fuel levy, you know, being raised, of which, I mean, that really impacts people on the ground. And these part of the people who will be impacted are these 11 million people who have lost their jobs, who are sitting at home, right? We also saw taxes in the liquor industry. Liquor industry has been hurt massively over the past year because of the lockdowns, right? Again, now you come and you impose the taxes so that, again, it dies even further, right? Because even the leaders of the liquor industry, I saw a headline this morning where they were saying that they will do some cost adjustments because they must, right? So, and they need to, you know, they need to respond, and part of that response will result in jobs losses. So I'm quite negative, and our government has lost credibility. And as Mike said earlier, history is quite a useful thing to judge upon, and judging on history between the ANC and how it does policy. And all the interest groups that are involved in our policy environment in South Africa, I think I'm really negative after the budget yesterday.
Phumlani, thank you very much for that. That's short and sweet and very powerful. You made it very clear. We're now going to go and going to ask the panelists. I'm looking at some of the questions, and the first one was, is an investment in the retail SA bonds a safe investment? That was the one question. The other one was, what about Regulation 28? When can we expect some changes to Regulation 28 and what's happening on that front? And then we also have a number of people asking about, and this is always the smart one, should we get money offshore now or wait for the rand to peak again? Now, that's the most difficult one. Maybe I should start with that question about the rand. Now, I always tell people, investors, the rand goes in big cycles. Sometimes it goes way overvalued and sometimes way undervalued. As we saw last year with the COVID crisis, the rand went to 1940 against the dollar, came back all the way down to, at one point yesterday, the rand was 14.34, and I saw some news headlines saying foreign investors very bullish about South Africa. Well, the rand has jumped around again today, and today it's trading at 14.85. So I wonder what the headlines will be today. So to follow the day-to-day movements of the rand is to drive you crazy. The answer about offshore investing, and of which Brenthurst has been a big proponent for many years, is not only based on the view of the rand, although that is a factor. It's also based on the macroeconomic situation on the ground and the profits companies make in a country, and in this case, South Africa. And Mike showed us very clearly that if you compare us against emerging markets, on many aspects, we are lagging very badly. We are also very lagging badly in terms of investment performance against the emerging market countries, and even more so against the developed countries. And just before I forget, on BizNews today, Alec Hogg's BizNews, there's an article of mine where I compared the investment returns of South Africa versus the rest of the world since Cyril Ramaphosa became president. And I just, for your benefit, I took 10,000 Rand as the starting investment and I put it into a number of local and offshore investments. While your local investments have given you a return of minus 40% in the case of property listed stocks to about 10% with funds like Allen Gray and PSG and so on. So effectively, if you had a portfolio of stocks over the last 3 years in South Africa, you've made no money. That is excluding the impact of inflation. Whereas the offshore funds have given you returns of between 25 and in one case almost 50% over that period of time. So you can see there is a very rapidly deteriorating situation as far as investment returns are concerned. But now let's ask Mike, what is his view on the Rand, firstly, and then secondly, would you put some money in an RSA retail bond? Can the government go bankrupt and say to you, Mike, sorry, there's no money left for you?
Magnus, I'll start with the government. Yes, the government can go bust. It can give you a haircut. I investigated a bit how it worked in places like Argentina. It went bust 7 times. But for South Africa, so far, we have not gone bust. And I would like to just say, I don't think South Africa is going bust in the next 2 or 3 years. The problem comes in year 5 or 7, down that line where we go to, where that possibility becomes real. So at the moment, if you've got a 5-year retail bond, you should be okay. Problem is the funds don't give you, other than the post office or Pick and Pay where you can choose a 5-year one. It's very difficult. You'll have to advise which funds give you that sort of maturity. The longer funds you can stay in for a while, but you don't marry them for certain. You, under these circumstances, don't marry them. On the Rand, I think the first thing is that market movements are not just South Africa. We're a little bath next to an ocean, and that ocean has much more assets in it, much more possibilities in it, but it influences a bath much more than the bath influences it on the foreign exchange market. I think at the moment, for me, I think the dollar is looking toppish, but who knows? And economists are extremely bad at forecasting things. But the big thing is, for somebody who's got money, even if you just take a diversified look and you say to yourself, okay, I'll leave 50% in South Africa or 30% or 20%, you can always do it in 2 or 3 stages. Then that way you get the average Rand over a time period and you're not caught out, because that's exactly what happened last year. Remember at 19, how many people were on the net and saying this is the end, and were phoning and saying, what do I do now? I'm but stuffed and everything like that. You want to take money out when the currency is relatively normal, or preferably actually strong. So where we are now is more on the stronger side. I think we can go at South Africa, we can go to maybe 13.50. But can we compete at 12.50? I doubt it. That's now dollar related. And that will impact the economy. Yes, it can get there for a short period, but don't bet on it. So at 14.50, roughly where we are now, take some money offshore. You don't have to do it all in one go. And that already diversified, because South Africa, our equities are 1% of the world equities. Our debt is 1% of the world debt, more or less. So the investment universe is outside of South Africa in every conceivable way. It's not just about South Africa either, but I would say always take some money offshore. And those of us who have to save, and we're getting to Regulation 28, through a pension fund, it is always valuable to save, no matter where you are. And a lot of South Africa Incorporated is very heavily invested in the rest of the world anyway, you know, Naspers, BAT, etc. So the fact of the matter is you want to save anyway. You save your taxes on it, you are highly taxed, and you have to look after yourself. And then, you know, whatever else, I'm not a specialist in the tax-free investment. I have a bit there, but I mean, I think it's very small fry that they allow us there. But Regulation 28 worries me because as government runs out of money, and if South Africa has, for any reason, is seen as higher risk again, the 35 or 32% of foreign investors still here, they will leave quite quickly. Or, and I think that's the other thing, when interest rates in the advanced countries go beyond, say, 2 or 3% above their inflation rate expectations over the decade, and when that thing turns, then I think we'll see a run out of our currency, because at the moment it's there is no alternative. Emerging markets are the only places where there are real yields to be had, and a lot of those emerging markets, like us, are risky. Some less risky than others, but that is not to say that emerging markets will not all of them will not pay. Most of them, I think, will pay and be able to pay. And I think South Africa, if we follow, if Tito is right, and we get to 85% and then go down, then I think we've made it. But if we go over 100% debt to GDP or 110%, that's very, very tricky area. And already where we are is record territory for us. And I think at sort of a 65, 75% level, even 85%, we should be able to handle the debt burden. However, the fact of the matter is, if it goes higher than that, that's where the big risk comes in. And then I would say for people in retirement, when you want your interest rates and so on, you have to go in South Africa in the shorter thing, and you have to take more money offshore. So you have to look at that situation as it unfolds. But right now, the Regulation 28 is when we run out of money, they're going to force pensions to take more of that government debt. It'll buy government time, probably 2-3 years, but I think after that, it's going to become very tough. It might even buy 5 years, but it will. Regulation 28, it can be changed by prescribed assets. That's the first thing. That's what I'm talking about. The second thing about Regulation 28, you can take 30% offshore. I'm hoping it changes that we can take more offshore. There was a suggestion by somebody, give us 40-50% offshore for Regulation 28 in exchange for lifting the bond thing from 25 to say 40%. I don't know if that's going to happen, but I get the feeling that Regulation 28 is not going to stand as it is for much longer. The other thing is these infrastructure things are just another way of helping our government in their debt crisis, because it's going to be public-private partnerships like we're seeing in the border in Beit Bridge. My last word on it maybe because I'm going to be boring, but the fact of the matter is that goes through RMB, that has a payment stream because people cross that border, so that's fine. But will all of them be able to have that sort of payment stream? And I sort of doubted on things like water and electricity, where already over 150 billion is owed by households to local authorities, and I think Eskom another 18 billion, if I remember. That's my story at the moment.
Mike, thank you very much. Phumlani, we've got a couple of questions about expropriation without compensation and what it can do to the economy, A, and B, what it can do to things like house prices or land prices, or maybe it has already had an effect on investment morale. Just your views on that, if you don't mind.
Well, I mean, you know, just one before I answer that question, Magnus, I just want to say something here to add on what Mike was saying. You see, my view is that in each and every long-term investor's mind, I think two words should be kind of ringing when it comes to South Africa. That is stagnation and uncertainty, right? Because there's so much that we are being told, and really there isn't a concrete plan on how things will be done, right? And there's also this sort of ongoing stagnation that we are seeing when it comes to our economy. And you mentioned earlier that as an investor, you are looking for sort of a profitable environment with good market returns, right? In South Africa right now, as you mentioned, that if we invested a few years back, today really we haven't made any money. So I think those two words, to a long-term investor needs to sort of ring in the mind. And then you've just spoken about expropriation of land without compensation, which right now is being driven by the state. That one is has been quite, it's a negative, it creates a negative atmosphere. And again, it touches very much more on that term I mentioned of uncertainty, right? Where it's really unclear as to what is it going to happen if I own a specific property, right? And many people have this idea that it's specific people who will be affected by the expropriation of land without compensation, whereas in fact it's everybody, right? Where politicians are really, what they are doing is to basically destroy or threaten, not destroy but threaten, private property rights, right? Which are fundamental and foundational basis for a strong kind of operational economy. So there's been much negativity around the expropriation of land without compensation. Let's remember, expropriation is practiced, in many countries around the world, right? But the key term here, and that sort of freaks out many people who watch these things closely, is around without compensation, right? And of course, there's been much political talk that amongst the people whose properties will have to be expropriated are farmers, and largely white farmers, because it's a race kind of driven debate given the nature of our politics. So I mean, that one has been quite, I haven't looked at sort of the direct kind of impact, the data. Maybe Mike has seen something like that as to how, especially from a property market point of view, what are the kind of patterns that one can spot them? What is the reaction? Is it causing changes on how the market is operating? I haven't sort of looked into the data, but from a sort of uncertainty point of view, it has created a lot. And the idea that we do know how irresponsible our government has been for many, many years. And we do know what is the ideology that drives the ANC. So as more and more controls around many things, including property rights are being endangered. So all those things are creating sort of a lot of uncertainty in an environment where we really don't need that.
Okay, thank you for that. I just want to make a couple of comments on Regulation 28, and I think there will be some announcement back in the next week or so, because that's an issue that's been bubbling under for quite some time, and I've been personally writing about and advising people that they must take the money out if they can and get it away from Regulation 28 funds. Because if you look at the investment returns of South African pension funds, retirement annuity funds, providence preservation funds, and I don't get the mainstream media wanting to write about this, but the investment returns have been between 0 and 3 and 4% over the last 3, 5, and 7 years. So most people who have money in any kind of pension fund have actually not made any money in real terms. So the advice at Brenthurst has been very consistently, if you're older than 55, you need to get your money out of the retirement annuity funds / preservation funds, and you can convert it into a living annuity with the 2/3, and then your 1/3 you can take out your tax-free portion and pay a bit of tax on the balance. So that's a very, very strong recommendation. But you'll never hear that's been spoken about in the mainstream media. It's against the interest of the big insurance companies. They don't want to see that money leave their hands. And but the results has been very, very good for our clients. And in my case, I did it 5 years ago with my own money. My returns jumped from 2%, which I had with companies like Old Mutual and Sanlam. My returns last year was 62%, and my average return 33% because I moved my money offshore. That leads me on to a next question. Someone has asked, if you do want to invest offshore, should you do it through an asset swap? In other words, you pay in rands, it goes offshore, but it comes back as rands, or should you make or get your money offshore directly? And I'm going to answer that question myself. It all depends on how much money you're talking about. For smaller amounts, less than 200,000, you need to invest on the local market, not because people are trying to be smart, but because the offshore investment companies have certain limits, and they will only take $15,000 around about that for an investment. And you also cannot make a debit order directly into an offshore fund. So up to that level, you do it with an asset swap and you do it through a feeder fund. The returns are basically the same, but the money comes back to South Africa. Then one question, maybe, Mike, I'm going to ask you this question, and it's a good question, and there's an answer to it. Why is the JSE doing so well the last couple of months? The last 3 to 4 months, the JSE has done very well. Maybe you want to make some comments on that, Mike, and perhaps refer to the commodity cycle.
Yeah, it is the commodity cycle, Magnus. I did a presentation for a Chamber of Commerce recently, and what was surprising is that the South African Commodity Price Index, that's the 4 big commodities that we have and 2 smaller ones. I exclude diamonds because I don't have that price. It's at levels that it was last seen in 2010. Iron ore has done particularly well, coal a lot less, but at the moment also platinum, palladium, and those group metals have also delivered because they are now needed again in the battery sort of car market. That's the first thing. And the second thing is, I think one must remember that South Africa went through a big dip, and the banks were saying no dividends, and now they have dividends. So the impact on the economy was a little smaller, not that much smaller, but where people were thinking a 10% decline, then up being about a 7.5% decline. And therefore, the prospects, the forward PE ratios have improved a bit, but it's mainly the commodity cycle, Magnus, no doubt about it. And obviously that has an impact on other, because the mines buy more and so on. So this year's growth from many economists from many places has increased a bit, where people were at first looking at, a 10% decline would give you a bigger bounce of about 4.5%. Then the decline was smaller, so they were talking about 3%. Now we're talking about 3.5% again. And I think that extra 0.5% comes mainly from the commodity cycle. I'll leave it there.
I think I agree with you. The commodity cycle has been very important, and it's one of the indicators we've been tracking for many, many years. When the commodity cycle is up, South Africa does well, the rand tends to strengthen, money comes in. But in the past, those proceeds or those windfalls have been spent and squandered. And I think part of the problems we have now is, in my view, a consequence of the previous commodity cycle, which was around 2011 to 10, where the windfalls was seen to have been considered to be permanent, and that the commodity cycle will never turn down. And we saw how it turned down. So the government was very flush in handing out money, wages and salary increases, and it was based on the assumption that the commodity cycle will stay elevated for a very long time. And then, of course, it collapsed, and we were very, very exposed. As Warren Buffett says, when the tide goes out, you will see who's not wearing bathing shorts. So we've been caught out very badly, and now we have another cycle. And the danger is that government goes and spends the money again. So we've been lucky the last 3 to 4 months, but as Gary Player says, luck counts. So we'll take that, and it has helped us with the revenue targets this year, and long may it last. Phumlani, one final word from your side before we say goodbye.
Well, look, for me, the environment is not good for anybody, not just your clients. Your clients are Magnus, but for everybody in the country. The outlook is still very much negative. There is basically really nothing concrete and strong being done. And the numbers that Mike show are basically a good sort of they give a good understanding as where we are likely to go. There are elections this year taking place. I have for a long time that if you really want to see change in policy direction, if you want to see things sort of improving, if you want to see unemployment going down, then my view is that there has to be change in those who are sort of shaping or are in charge of the country, those who are governing. Because so long as they are in charge, at least in my view, then we are not going to see improved sort of pro-market, pro-business, less regulation, open kind of an economy. You are not going to see that, because they have a different ideology of how we should organize our economy. And so long as we have them, and we've seen how they think has got us where we are here because of their ideas, right? That have impacted everybody, including your clients, Magnus. So, I mean, then there has to be a change and it begins in local governments. We have been speaking about the troubles that municipalities are facing, and with the local elections this year, it begins there, right? The issues of whether we have potholes issues, water shortages, and so on and so on, that really cannot be done properly in your community. And the local elections will be important this year. And every South African should go and make a difference if they want to reshape the direction of the country. And that direction includes economic direction, right? Because I mean, if we have wrong people, we will remain in this stagnation, uncertainty, and high deficits, high debt, high unemployment, and so on and so on. That just drives away investment.
Phumlani, thank you very much. I agree 100%. Mike, your views?
Well, I just want to answer a little bit of a question as well in a different way that was on the chat. I think if you're young and you can invest and so on, then our RAs and those sort of things are still good because you get a tax break. And you will maybe have more prescribed assets in future, but up to 200 and you can help me, 247,000 you can take out again, Magnus.
Correct, yes.
If you're young. So
yeah.
if you haven't got anything, because that was one of the questions, you can build it up to that level without the risk or much of a risk. And you can take it out. And what you can do then is maybe start another one. I don't know how they're going to handle that. Or you can, and then the tax-free investments are also not that restricted. So those are the things that you need to look at, and you still need to save. That's for all the young people out there. Please still save. You don't want to get old with no money in the bank, if I can put it that way. And that's maybe an old way of putting it. But yeah, that is what I wanted to say. My final word would be there is going to be a fight on the prescribed assets under Regulation 28. I think it won't come now. It seems to have been patted down a bit by our local fund managers by saying we will invest in this infrastructure as soon as but infrastructure in itself, if it cannot pay for itself, if there's a dam that needs to be built and there's nobody paying for it, then the fund managers can't invest, or nobody pays for the water, then the fund managers can't invest in it. So I think that prescribed assets has probably been put away for 2 years or 3 years, but it will be a big fight going forward. I think me and Magnus agree on that. It's just a question of timing. I think my other view is if you want to take some money out, now is not a bad time. You don't have to, as I said, take everything out in one go. But if you take out now and the rand strengthens then to 14, then you average, say, 14.25 taking it out. You will get a return when the rand weakens in a year or two's time or 3 years' time. The commodity cycle, yeah, it did help the rand for a number of years, but it doesn't do it permanently. And that is the thing. So you have to look at that. Also, if the rand weakens, you've taken out some at 14 rand 15 and weakens to 15, I'm just using a dumb example, then your average is 14.75. So you don't need to not take money out. I think you must make part of that decision now, because we don't know as economists exactly where a currency goes to. We don't know where all the investments are, but what we do know is diversification is very well linked to your future financial well-being. And that's my point that I'd like to make. It's not just about South Africa, it's about how you can diversify. That's it.
Mike, thank you for that. It's a bit more than that. I'm going to support Mike in saying young people should save. I would say your starting point should be your tax-free savings instrument that you can use up to 36,000 Rand per year. And therein, I would recommend some very, very exciting and innovative offshore funds, whether they're feeder funds or ETFs. And because we're lagging the rest of the world in terms of innovation, and I would be putting money into things like the Signia Fourth Industrial Revolution Fund, the FANGS funds, even something like the Brenthurst, the Worldwide Flexible Fund. These are all funds that have been doing exceptionally well. So for young people, their parents should open that account and start putting money in every year if they can afford it. And 10 years goes by very quickly, but you want the aggressive growth portfolios. For older people around about 55, you need to consider taking your money out of RAs. And then, as Mike said, there's a very nice little strategy that we follow at Brenthurst. We take people out and then we put them back in again, and we take them out again, because you get some very nice tax breaks. But I'm not going to say too much about that. But there are some ways of putting money into an RA over the age of 55, and by doing one or two things, you get your money into 100% offshore funds. But I'd like to thank our panelists, Phumlani, Majozi. That was good talking to you, Phumlani. Mike, welcome on board at Brenthurst. And I want to thank everybody who spent time watching and listening to our webinar today. And that's why we have independent opinions, because that's one of the biggest issues in South Africa is the local asset management industry is considering some of the hard realities that we are faced with. I just want to end my little presentation by referring to Argentina. There's a question, what happens when we go over the fiscal cliff? Well, have a look at the exchange rate of the Argentina peso versus the US dollar over the last 5 years. It kind of moved along at between 3 and 4 against the US dollar, and then 3 years ago or so, it shot up to 75. Now that's what happens when a country goes over the cliff. The rand collapses, you can't pay your debts, and people want their money back, and that is not something you want to endure when you have all your money locked up in that particular country. I'm not saying it's going to happen. I'm saying it could happen if we carry on with the continued ideologically driven economic policies, which are just astounding the rest of the world. But be that as it may, from me, Magnus Heystek, and the Brenthurst team, my very capable team behind the scenes, Dalian van Wyk and Sue Heystek, who made all this possible, I say to all of you who listen, thank you very much. And you can also have a look at my article on BizNews today. But thank you very much, and good afternoon.
Good afternoon.